Welcome back to Wealth Effect. This week we saw the world's most valuable nonprofit stand trial for its soul, while titans of the S&P 500 proved that the certain scale, it's still a struggle. From the UAE's historic goodbye to OPEC to the brutal mathematical reality of the prediction markets that are supposed to be the real source of truth for everyone when betting. In today's episode, we're going over 5 stories that define the current state of the markets. The federal courthouse in Oakland, California has become the center stage for the technology this week, as it marks day 4 of Musk versus Altman trial concluded. If you have been keeping track of the narrative of artificial intelligence as the battleground for algorithm, this trial is a stark reminder. The real war is being fought over corporate charters, fiduciary duties, and the definition of a promise. Elon Musk completed his historic testimony Thursday last week, having spent hours in a black suit attempting to convince the jury that he was essentially the founding fool of a nonprofit. The core argument is that OpenAI, which was established in 2015 as a nonprofit dedicated to the safety of development of AI for the benefit of humanity, has effectively abandoned its soul to become a closed source profit maximizing subsidiary of Microsoft. The importance of this case cannot be overstated because it strikes the heart of how Silicon Valley builds its most powerful entities. Musk's legal team is pursuing claims of breach and charitable trust and unjustment enrichment, arguing that the transmission of OpenAI into the Public Benefit Corporation, or PBC, last year was a final step in the multi-year theft. Musk testified that while he is now opposed to a small for-profit adjustment fund to the mission, he never intended for a tail wag of the dog. From a perspective, the $38 million he injected during the early years was seed money for the global utility, not a down payment for what the entity is now an eye-watering $1 trillion valuation. OpenAI's defense, led by William Savert, has been surgically precise in its brutal framing into the pivot as necessary rather than a moral falling. Their argument is grounded in brutal economics of 2026 AI landscape. Development of artificial general intelligence, AGI, requires the level of capital only achievable through corporate structure and not as a nonprofit. They have pointed to Elon Musk's own ventures such as XAI and Tesla, noting that he operates them for a profit mechanism while keeping his most competitive models behind closed doors. The defense is essentially asking the jury to ask a fundamental question. Can you truly innovate on the bleeding edge of science and technology without having the incentive structure of the capital markets? The stakes here are measurable in 11 figures. Musk is seeking $134 billion in damages, a number derived from its perceived unjust enrichment of founders and early investors. And as he stipulated, every cent awarded to him will go back into the OpenAI Foundation, the nonprofit husk that it still holds a minor stake in the operating company. More importantly, Musk is asking the court to remove Sam Altman and Greg Brockman from their leadership roles and effectively unwinding corporate restructuring. This is a poison pill for OpenAI's rumored IPO, which many on Wall Street expect to be the largest in history at the moment. If the jury finds that the conversion to a PBC has breached trust, the legal cloud could freeze the company's ability to access the public markets for years. Musk is fighting a world where the most powerful technology in human history is a public good, while Altman is building a world where that technology is a product. The judge, however, has provided a significant hurdle for Musk's safety-first narrative, ruling that the trial must focus strictly on legitimateness of charitable trust rather than the existential risk of AI or extraction events by stripping away the save the world rhetoric. The court has forced both sides to argue on the cold, hard grounds of Delaware style of corporate governance. For the broader market, the outcome will set the precedent for every mission-driven startup in the pipeline. If Musk wins, it sends a message to the founders of early nonprofit commitments are binding contracts that cannot be discarded. If OpenAI wins, it confirms that the nonprofit to for-profit pipeline is a viable strategy, legal strategy for scaling capital incentive research. As we look towards the 4-week trial, the industry is watching to see if AGI will be governed by the ideas of its founders or deemed an item on its balance sheet. This is the ultimate stress test for the integrity of corporate missions in an age of infinite scale. And moving on to our next story. For the last 3 years, the narrative surrounding OpenAI has been one of exponential, almost supernatural growth. But for the week, the infinite growth armor showed its first visible cracks. Reports surfaced and were quickly followed by ridiculous and clickbait dismissals from leadership that OpenAI has begun missing its own aggressive internal targets for both revenue and user acquisition. The most glaring figure is 1 billion mark. The company had reportedly set an internal goal to reach 1 billion weekly active users for ChatGPT by the end of 2025, a milestone which had yet to be announced or, according to internal leaks, actually hit. When your valuation is anchored at nearly $1 trillion, missing the mark, it won't be a rounding error. It's a fundamental threat to the business model. The market is starting to realize that even a company that redefined the internet is not immune to the gravity of user fatigue and the brutal reality of multi-competitive war that the AI space is now in. The internal tensions at OpenAI appears to be crystallizing to a strategic scheme between CEO and CFO. While Altman pushes the aggressive internal public offering as in early 2026, a move necessary because of its burning rate that could not exceed $15 billion this year, its CFO has reportedly voiced a caution. His concern is grounded in the terrifying math of the infrastructure. OpenAI has committed over $600 billion in data centers and cloud contracts over the next 5 years. If revenue growth begins to decline, those fixed costs don't just become a burden, it basically becomes their extinction plan. Reports suggest that the CFO is pushing the delay for the IPO until 2027 to ensure accounting hygiene and revenue predictability that the public market investors demand. You cannot walk onto the New York Stock Exchange with a "trust us, we're building AGI" pitch if your core subscriber base is showing signs of basically burnout. Your enterprise growth is being cannibalized by rivals like Anthropic. This competitive friction is a story that gets particularly sharp for the audience. For the first time, OpenAI is no longer competing against legacy tech. It's being overwhelmed by other AI companies. While ChatGPT remains a household name, Anthropic's Claude 4 and Gemini 1.5 Pro have made significant progress into the coding and enterprise sectors, two areas which OpenAI assumed it would be the primary profit for its company. Market share data shows that ChatGPT's portion of AI-related web traffic has dipped from dominating an 86% to roughly 64% in a single year. In a world where venture-backed hyper-growth, a 20% drop in market share is basically costing your whole company its evaluation. If OpenAI enters the public markets right now, its defense would be rather pathetic because it's sitting at the forefront of AI development, yet its market share is still declining. The IPO paradox for OpenAI is pretty simple. They need the public markets to fund their $100 billion Stargate supercomputer ambitions. But the public markets may not have the stomach for a company that's projected to lose money all the way up until 2030, while growth is plateauing or even declining. This week's news of missed targets have already spooked the broader ecosystem, while partners like Oracle and CoreWave seeing the risk of its own stock dip. Investors are beginning to ask the unit of economic questions. How much does it actually cost to acquire a $20 a month subscriber when your computing costs are still a magnitude higher than a traditional search engine? OpenAI is efficiently a giant research lab trying to masquerade as a high-margin software-as-a-service company. They need to start bridging the gap so that their IPO can be the largest in its history. Moving on to the next story about Meta. If you spent your week watching the ticker of Meta platforms, you likely saw a sea of red that was a big disconnect from the company's actual growth revenue. On the surface, Meta is a cash printing machine, reported a 33% jump in revenue, the fastest pace it's had in years. Yet the stock was at 10%, and it seemed like what happened? The immediate culprit is a struggling update for capital expenditures forecast. While it has been a hike range from 125 billion to 145 billion for 2026, basically to put that in perspective, Mark Zuckerberg is planning to spend more on AI structure this year than the entire market cap of most companies in the S&P 500. This is a massive spending pivot, and it comes just after a company attempts to shortcut its way into agentic AI race was basically blocked by Beijing. The centerpiece of Meta's tactical struggles this week was a forced unwinding of its $2 billion acquisition of Manus, a Singapore-based AI startup that was supposed to be an action engine for the entire Meta ecosystem. Manus was a darling of the agent AI movement, developing software that didn't just talk to you, but actually executed multi-step tasks like booking travel, analyzing complex financial data, and building websites from scratch. However, despite the founders' attempt at Singapore washing, reallocating their headquarters and staff escalated to reach Chinese regulators. The National Development and Reform Commission of Beijing stepped in Monday to block the deal, citing national security and technology export controls. China has essentially reclaimed the intellectual property, leaving Meta with a $2 billion hole in its road. A group of employees in Singapore who are now legally adrift. This regulatory setback is a growing fear among investors that Meta is spending at an infinite scale without a definitive roadmap. When pressed on the $145 billion in hardware and energy costs will actually turn the bottom line profit to go up, Zuckerberg's response was basically pretty blunt, suggesting that the hierarchy of product development, profit comes fourth. In his view, the priority is quality, then scale, then the revenue model. For a visionary, that's a roadmap. For Wall Street analysts looking at a 10% stock dip, a $25 billion bond sale to fund the spending spree, it sounds like a recipe just like they predicted the Metaverse 2.0 disaster. The market is increasingly skeptical that the massive computing power being purchased today will find a high margin return before the advertising cycles eventually slow down. The broader implications here are that the AI race is no longer just about who has the best researcher. It's about who can survive the geopolitical and financial friction of the era. By blocking the Manus deal, China has sent a message that will not allow its top AI talent to be harvested by American giants, regardless of where those companies choose to incorporate. For Meta, this means that they must return to dwelling abroad to build their own agent capable from the ground up, while their primary revenue source, advertising, faces a projected slowdown in the coming quarters. Our next story isn't about AI, but something that is impacting everyone right now. The shift in the global energy market has basically hit a big milestone. Last week, the United Arab Emirates officially terminated its nearly 60-year commitment to OPEC. Effective May 1st, which already happened, the UAE is no longer bound by the production quotas of the group, making it a more significant departure from an organization to its inception. While rumors of an exit has swirled through the halls of Abu Dhabi for years, the timing of the announcement caught the world off guard. For decades, the UAE has been a quiet, reliable partner to Saudi Arabia, acting as the second pillar of the Gulf stability. While walking away now, President Mohammed bin Zayed has sealed the era of the collective Gulf oil policy, replaced by a nation-first strategy that prioritized sovereign monetization over the cartel-mandated scarcity. The catalyst for this split isn't a single event, but a fundamental management of the money. Over the last 5 years, the UAE poured more than $150 billion into Abu Dhabi National Oil Company, specifically to expand its production to 5 million barrels per day by 2027. Under their scrutiny of OPEC, the UAE quote has been frequently pinned at nearly 3.2 million barrels, meaning that Abu Dhabi was effectively paying billions of dollars to build a massive engine it's legally forbidden from using. From the UAE's perspective, the energy transition is no longer a destination theoretical threat. It's basically an active countdown. They're operating on the cold logistic that every barrel left on the ground by 2040 might be a barrel that never finds a buyer at the basically profitable price. They want to sell their inventory now while the world is still wanting it. They are no longer willing to subsidize a fiscal break or lower prices for members like Russia or Venezuela. This exit also exposes the basically widening rift between UAE and Saudi Arabia, two nations that were once inseparable but now are fierce competitors in the regions for dominance. While Riyadh remains committed to the high price strategy to found its vision of 2030 projects, Abu Dhabi is pivoting towards a high volume diversification model. The friction has spilled over from oil into everything from regional logistics to high tech investments. The UAE is incredibly positioned itself as the Switzerland of the Middle East, a neutral tech forward hub that is more interested in global trade and artificial intelligence than maintaining a 20th century oil monopoly. By leaving OPEC, it has effectively removed the last major constraint on their ability to act as a truly independent actor. A move that has weakened the cartel's ability to defend the price floor and fundamentally change the risk profile of every energy desk in the world. For the global economy, it immediately impacts UAE's departure is being masked by the ongoing conflict in West Asia and continued its closure of the Strait of Hormuz. In a vacuum, the addition of nearly 2 million barrels of space capacity for the market sends oil prices in a tailspin down. However, because of the primary exit route of the Gulf is currently under geopolitical tension, the UAE's newfound freedom is basically not going anywhere really soon. Market analysts at Goldman Sachs and Morgan Stanley have already pre-priced the 2027 forward to curb anticipation losing market once the regional security has been basically opened. The OPEC premium that investors have factored into oil prices for decades is evaporating and replaced by a new era of supply side competitiveness that could make energy significantly cheaper in the long run, providing the infrastructure to move and remain intact. OPEC succeeded in the 20th century and became its members shared a common existential threat and lack of alternative. But in 2026, the UAE seems its future to not be tied to the price of an oil barrel, but in its effective use of data centers and research on its sovereign wealth fund. They have realized that the world's racing towards a post-carbon economy. The most valuable asset isn't oil itself anymore, but the capability to be flexible and pivot away from it. By breaking the 60-year deal, Abu Dhabi has bet on its independence is worth more than the safety of being in a group. The era of the swing producer is evolving. For the first time in generations, most powerful player in the room might be those who refuse to play in a group. On our next story, if you were looking for a sign that the era of efficiency was over and the era of unbounded expansion has returned, look no further than the Q1 2026 earnings report from basically three titans of the modern economy. For years, the bears have argued that the sheer size of Amazon, Google, and Apple would eventually create a gravity wall, pulling their growth rates down towards the single digits. This week, however, the gravity wells were seemingly obliterated. We saw a rare moment where companies with a multi-trillion-dollar market cap were accelerating like agile startups. This isn't a beat and rise cycle. It was a fundamental resistance of dominance that proved that the modern digital infrastructure is still got a twinkle in its eye. Amazon is the primary exhibit of this reality. The company reported a 17% increase in net sales to $181.5 billion. But the real story is hidden behind its pipelines of the internet. Amazon Web Service, which many feared was a maturing and going into a slow growth utility, just posted its fastest growth rate in 15 quarters, surging 28% year over year. This acceleration in cloud computing is being driven by massive migration of enterprise workloads to generative AI environments. When you look at Amazon's $43 billion in capital expenditures this quarter alone, you realize that they are effectively prepaying for the next decade of internet dominance. They are no longer just a retail store. They are basically the landlord of the computing grid. Even their side bets are hitting critical mass, with their environmental division, Project Hail Mary, crossing $615 million at the box office, suggesting that Amazon's vertical integration model has now successfully cannibalized the entire ecosystem alongside with logistics and data centers. Google, through the parent company of Alphabet, mirrors the narrative of a high scale. Alphabet's revenue hit $109.9 billion, a 22% jump that represents the fastest pace in 2 years. The market has particularly struck by Google Cloud, which saw a meaningful acceleration of 63% growth, reaching a $20 billion quarter run rate. The massive reinvestment in search profits into cloud infrastructure that has now self-sustaining and expanding margins. By expanding the operating margin to 36.1% and increasing its quarterly dividends by 5%, Google is sending basically a crazy message. They are the capital fund of $190 billion AI spending spree this year, while simultaneously paying shareholders to stay in the ride. It is a position that basically is confidence that mocks other AI companies that are struggling. Moving on to Apple, it's basically defying its own narrative for its own decline. After several quarters of mediocre performance that led to the label basically being a mature market, the company delivered a 16.6 revenue jump to $111.2 billion. While the hardware cycle is always a headline, the real basically victory was its margin. Apple reported a gross margin of 49.3%, a level of profitability that should have been impossible for the company that's moving so much physical products at such an astounding volume. Perhaps the most shocking thing to analysts was that Apple expected June quarter to maintain double digits growth between 14 and 17%. For a company with an installed base of 2 billion devices, a forecast of that kind suggests that Apple Intelligence and a new OS cycle isn't just an incremental update, but that the target will be met and exceeded. Basically, for these companies, as an investor, you have to recognize that these companies are no longer just tech stocks. They are in everything from computing power, processing data, to consumer infrastructure and products themselves. And they could be entering within the few years a small hyperscale of its own structure. And our final story is about prediction markets. If you've been following basically the rise of Polymarket, you've likely heard to describe as basically a truth machine, a decentralized oracle that uses wisdom from a crowd to predict whether there'll be Fed hikes or the next global conflict. But on an extensive on-chain analysis released this April, has pulled back on what is actually happening behind these markets. And the reality is pretty disappointing. While the platform's total volume has exploded in tens of billions of dollars, the profit structure is crazy. Of the 2.5 million wallets analyzed, a staggering 84% of them had lost money. Even more crazy is the scale of these losses. The average retail user is currently about $1,100 in the red. And this isn't a market in the traditional sense. The vast majority of participants is basically a high-speed wealth transfer from human interactions to an algorithmic interaction. The math of those who are actually winning reveals that a digital divide is almost impossible for mature trading to bridge. The report found that tiny elite, less than 0.04% of all the wallets analyzed, captured over 70% of all realized profits, totaling more than $3.7 billion in profits. These aren't the lucky guessers. They are high-frequency bots and institutional market makers. These automated systems operating on Polygon nodes with sub 100 millisecond execution times, while humans are still reading the headlines and processing the emotional weight of this news story and how it impacts them. A bot has already scanned the text, calculated its probability, and executed a trade. In 2026, the duration of an average arbitrage opportunity has basically shrunk down to just about 2.7 seconds. If you're clicking the button on your browser and you aren't already trading, your profitability just went down. When we look at the demographic of the truth machine, the age gap is the most striking feature of the winning cycle. The data suggests a small percentage of profitable human traders is overwhelmingly in the 22 to 34 old market bracket. specifically those with backgrounds in computer science and quantitative finance. This basically GC quant class has significantly gamified information, treating geopolitical disaster and military strikes as a mere data point on a spreadsheet. Conversely, the older demographic who entered the market during the 2024 election cycle has seen steep losses, often failing to account for decay of contracts as they approach settlement dates. This is basically a world that is run by the youth, and everyone else is just tossing in for fun. The geographic distribution of betting activity also tells us basically two different stories of America. The city versus the country divide in prediction markets is sharp. Urban centers like New York, San Francisco, and Miami account for nearly 65% of the total US demographic volume. The users tend to bet on macro events such as interest rates, IPO valuations, and tech milestones. In contrast, users in rural areas and smaller townships represent a smaller but a more specialized segment, focusing heavily on commodities, weather events, and culture war outcomes. This geographic constraint has led to a fascinating urban bias in the odds. Markets often reflect the sentiment of a coastal tech worker more accurately than the reality of a broader nation landscape, creating blind spots that bots are exploiting. As we look at the state level engagement in 2026, the clear top 5 has emerged the total trading volume per capita, despite various logistic and legal pushbacks. These 5 states represent the engine of the American prediction system. The first being California, driven by a Silicon Valley tinker class, a massive appetite for tech-related contracts. The second being New York, basically the home of financial professionals who treat Polymarket as a high leverage hedge against traditional equity positions. The third one being Florida, basically a hub for the crypto narrative of wealth that helped build the platform in its early liquidity. The fourth being Texas, which sees a massive surge in volume related to energy markets and the power grid. The fifth being surprising, Virginia, which reflects an insider class which primarily focus on the capital, which has led to heavy betting on legislative and defensive related outcomes. The prediction markets aren't what they were before the involvement of high frequency trading bots, so be careful when you trade. And that was basically the landscape for the end of April, beginning of May. Remember that in this economy that's going crazy, you should really only focus on your money and not all these prediction markets that you are unsure about. Thank you for listening. Until next time.